Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the companies that has gone through an absolutely crazy run over the last few months is Carvana. And that's because the company has been able to refinance some of its debt, came out with results that were a little bit better than expected in the second quarter. And so the stock shot higher. But there's still a ton to be concerned about this company, and this is absolutely one I would avoid. But I want to get into exactly why. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. First, I want to go through Carvana's performance over the last few months. You can see here that Carvana stock is up 404% over the last 6 months as I'm recording. But if we pull back a little bit further, the performance is a little bit different. 1 year up about 61%. And you can see that shares actually peaked at about $360 per share in the middle of the pandemic. So there's been a huge pullback in shares, but a big recovery recently. So what is the reason for that? One was the better than expected performance in the second quarter of 2023. You can see here the total gross profit per unit was $6,500, just an incredibly high number. This is partially because used car prices have remained relatively high, and Carvana has been able to take advantage of that. But you can see that units sold was down 35% in the quarter, revenue was down 24%, and the company still lost money on a net income basis. So what were investors really getting excited about? This is the big thing here. The company agreed to refinance a vast majority of its debt with debt holders. These are the details of that refinancing. I'm going to start with what is going to be exchanged. So this is what's going to be taken off the balance sheet. $5.5 billion worth of senior notes due from 2025 through 2030. And there will be new senior notes issued that are due from 2028 to 2031. The idea here is to reduce the amount of cash the company has to spend on interest over the next couple of years. But you can see there's a big cost associated with that. The company recently raised $350 million from an equity sale, and most of that money goes to note holders in exchange for making this exchange. So what's actually going to be in the balance sheet in the future? The idea that they're reducing cash interest payments is theoretically a good one. But what they're doing is they have three different tranches. And in the first 2 years, most of the interest is paid through what's called payment in kind notes. That's basically just, hey, we will give you more debt that will make interest in the future rather than paying you cash. It's kind of like kicking the can down the road further. So these are the three tranches, $981 million due December 2028. And of that payment in kind interest in year one. You can see that transitions to 9% cash or 12% payment in kind in year two, and then 9% cash thereafter. Callable, which means the company can buy it back at a small premium in year 1, 2, and 3. Similar details in tranche 2, except for the interest rate goes up to 13%, and tranche 3, which is $1.74 billion worth of debt due 2030. The interest rate is now 15%. So it's great to say that cash payments are going to be reduced, but the amount of debt is going to still be over $4 billion. And over the next 2 years, that's likely to increase about 20 or 25% because of this payment in kind interest payments. Now, this was also just released that most of the company's debt holders did agree to this exchange of notes. 80% of notes due in 2025, up to 99% of notes due 2031. That makes sense because those were the note holders who were going to be in trouble if the company filed for bankruptcy. In the meantime, they can just kick that can down the road a little bit and get a little bit higher interest rate. But this is really the exchange the company has done. They're saying, we're setting up the company well over the next couple of years from a cash flow standpoint so that we don't have to pay this debt burden that we can't afford right now, and hoping that the market or the stock improves in the next 3 years so that they can theoretically pay this debt back. The problem with this strategy is you have to have a fundamentally strong business to ultimately have it pay off. So is Carvana going to be able to improve the bottom line over the next 3 years so that they can pay off this debt and actually return some cash to shareholders? I don't think the answer to that is yes. The only benefit right now is that they may be able to use the stock and the currently high stock price to potentially buy back some of that debt. Remember, I said it was callable, so they could issue debt. So they could issue equity and buy back debt as a result. But that's not a great way to finance your business. Right now, the company's debt problems, I think, are just too big to overcome. Remember, Carvana is not profitable. The company has not generated net income over the last, at least since 2016. That's the numbers that I'm looking at right now. So how are they going to pay back more than $5 billion worth of debt? I just don't think there's a good answer to that. So this is absolutely a stock I would stay away from. Obviously, it has had a nice run, but I think that's more speculation than it is a fundamental improvement for the business. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.